and I have a feel of exactly how you understood some of these aspects. So I'll really seek for your attention as much as we can. I'll go back to the first chapter, which was Introduction to Insurance. And these terms, I need any of you to be that they're all at your fingertips. Somebody ask about this, you are in position to express it from within your mother tongue or your own understanding. So I'll start with one question. What is a peril? And I'll nominate Jennifer to answer that. Jennifer, are you there?
Yes, sir.
What's a peril?
A peril is a cause of a loss. It's a condition resulting in a loss.
It's a condition
resulting in a loss.
Okay. Mitara, what is a hazard?
A hazard is a condition that increases the event of the loss.
Okay. Tabi there?
Yes, I'm around. Yes, I'm around.
Hello. Tabi, are you there?
I'm around.
Tabitha,
Hello.
Are you there?
Hello. I'm around. I'm available.
Yes. What's give example of a hazard. Okay, give an example of a hazard.
Can I confused because it's the first time I'm logging in. I'd not attended the class previous day.
Excuse me. Excuse me.
Hello.
Hello.
Are we still together? Hello. Hello. Serious. What's going on?
Hello.
Hello.
I'm sorry, connection. Are we all back?
No.
Are we all back? They're trying to regain the connection.
Yes, sir.
Hello. Jennifer?
I just got the audio.
You only have the audio.
And yeah, and I see you, but your presentation, has it gone off?
It's on. Is it still on?
No, sir. I think
no.
you have to share the screen.
Share, but just allow me a flash a minute.
Morning, how are you? I'm good, good.
Can you see me?
Sorry?
Brenda, can you see me?
What happened?
Yeah, we can see you, but we are not seeing the presentation, sir.
Okay, hold me. Just allow me just a minute.
Yeah.
Morning. Morning, how are you?
Oh, the class on?
Sir, it has come now.
I'm sorry. Sorry about the glitch. Back to my question. Yes, I was asking about example of hazard, and I was asking Tabitha. So, okay, are you there?
There is a physical hazard
Matthew, are you?
and a moral hazard. So I'm there. Yes, I'm there.
Example of hazard.
There's a physical hazard and a moral
Example
hazard.
of hazard.
Another
Hazard.
fraudulent claims.
Okay, it can be a moral or a physical.
Yeah.
Anything.
Yeah. Under moral, there is fraudulent claims, lodging, exaggerated losses. Can you get
Thank you, Matthew.
welcome?
Thank you, Matthew. Though you are not audible enough, I will ask Rahul. Rahul, are you there, Chaka?
Yes, sir.
Can you give me an example of a period?
Peril can be the cause of loss, like a fire or an accident.
Okay. Perfect, perfect. Okay, I'll ask one more question, then we can proceed to what are the functions of insurance? And I'll call one person. There are only 4, so I'll seek from 4 participants. Brenda, give me one function of insurance.
Hello.
Brenda, one function of insurance.
It helps in providing protection or security to
Protection,
people.
security. Another person, Tabitha, are you there now?
Yes.
Function of insurance.
Hello.
Brenda, you are there?
Hello, I'm there.
Function, one function of insurance.
Hello.
Yes, I can hear you.
I've said it helps in providing protection or security to people and their properties. Then another one, it helps in providing employment opportunities to people. Third,
What's the name? Shama, can you hear me? Shama, can you hear me? I'll ask those who have unmuted, because I've told you unmute within this session. Rahul, do you have any function of insurance?
Yes, sir. Insurance can finance the government or any other banks.
Okay, financing. Okay. What's the name? Mr. Geraldine Chisembo. Any function of insurance?
Provides a peace of mind.
Provide a peace of mind. Okay, now, the reason why I asked this question, because I need to see that we don't fail our exam, right? The function of insurance, there are only 4. And with all whatever is mentioned, with due respect, they are all wrong. Yes, they are all wrong. So whatever I'm talking about at this point in time, they are all importance of insurance. Yes, I repeat, we're talking about importance of insurance. Those are non-functions. Eh? Function one is risk transfer. You learned about risk transfer. Hello?
Yes, sir.
You learned about creation of a common pool. Hello? I'm assuming you are listening.
We are listening, sir.
Yes, you learned about equitable premium.
We did.
You did. You learned about spread over risk. That point may not be there in your notes of spread of risk. Those are the 4 functions of insurance. Are we all together?
Yes.
Yes, sir.
So now you need to change your thinking from importance to function. I just wanted to draw clarity because I know some areas where students tend to fail on something which are very easy. Are we together? Perfect.
All right.
Now those are the functions. The other one, you are giving employment, opportunity, financing, all those are importance of insurance, they are non-functions. I just try to guide you as your team leader within this course. Now let's go to our topic today, which is about functions of insurance. Principles of insurance, apologies. Principles of insurance. Now when you talk about principles, yes, these are more of what we base on as insurance company when you are going to either charge premium or when you are going to operate within the market. So these are like more of the cornerstone, all the foundations that will always draw us attention as we're doing business from any other kind of business. And the principle, there are 7, though the most which are always pronounced, there are 6. So the first one, as you can see within the content, we have the principle of insurable interest, utmost good faith, proximate cost, indemnity, contribution, subrogation, and the last one being loss minimization. And as I'm guiding, can you all unmute right now? Can you all unmute from your end? Maweji unmute, Brenda unmute, Tabitha unmute, Fiona unmute, Geraldine unmute, and the rest who have not unmute, please do so. All of us, let's unmute. Are we all, that's what we are going to cover within this very moment. Okay? And it so happens that if you've not understood this topic, it is a center of concentration when it comes to continuous assessment or CAT. So let's all mute. Let's all mute. Let's all mute. Let's all mute. And please throw your questions as and when. Please, let's all mute. So let's start from draw and understand, which you've already had within the first discussion by you understanding what is insurance. Basically, insurance is a legal contract where there is a risk transfer from a policyholder. Now, a policyholder is the insured, somebody who brought the cover to you, and insurance provider. So you have this risk, you have your car, it can crash in an accident. So for you to transfer that risk to an insurance company, when you pay premium, so you are protected from any financial losses or liability resulting from unexpected event. So the point here that we are trying to draw attention to, that if the loss has to occur, that loss that we are supposed to pay for should be resulting from unexpected event. So if the event is expected, then that one is not insurable. So in that aspect, since you are protected, you are able to maintain the existence of the wealth, thus mitigating losses. So at the end of the day, your wealth is maintained. If you have a building and collapses out of fire and the insurance company pay, then you are able to maintain the same status in terms of wealth because the insurance company will definitely pay you. We progress. So the principles of risk management, these are, when you go back to our principle, these are exactly concept of risk management that we presume as insurance company that whatever that we are going to handle, it is based on unexpected outcomes, all right? In which we look at it in terms of the law of large numbers will apply for us to say that insurance company, they can quantify the losses to determine what has to be indemnified. So how does the insurance company work? Because we need to understand that subject. Insurance company always collect premium. Yes, we collect premium. And I'll ask a question as I'm explaining this slide here. Creation of a common pool. What did you understand by a common pool? Creation of a common pool. Tabitha, you didn't mute, but I can ask you. In fact, let me ask Olivia Musimenta. Olivia, are you there?
Yes, I'm here.
What's a common pool?
I don't know exactly.
Sorry? What's a common pool? Rachel, are you there? Rachel, are you there?
Yes, sir, I'm there.
What's a common pool?
The group of the
Rachel, are you there?
Yes, sir.
What is a common pool? Creation of a common pool.
Creation of a common pool.
Yes.
Is a group of people with a same risk.
Mm-hmm. Which are brought together, and a loss which are brought together in terms of the risk. Okay, when you talk about creation of a common pool, we look at that you bring risks which are homogeneous or which are similar, and they are brought to one basket, or they are brought together, such that if at all there is a loss from one individual, yes, then the premium, which is a portion of the premium, it is picked from there and it pays for the big claim. Why I brought up this, when you look through here, we have a common pool. Here you look at all the premium which are coming through. So they are brought to that pool where there is the curve of insurance. However, when you look how they pay out in terms of check, the amount which are paid, they are huge sums than the amount which are brought in terms of premium. So that's what I've tried to demonstrate to you. That's the way how insurance works. You have several insurance companies. You can look at here, there are so many, right? But the losses you've paid, they are only two. But the magnitude of all the amount which are paid, they're exceeding the amount which are brought in, right? From an individual. So you bring in 1 shilling, they pay you 10 shilling as an example. So that's our common pool, okay? So let's start our principle by looking at insurable interest. And I'll try to engage you to appreciate whether learning is taking place or to see whether I need to explain further. So when they talk about insurable interest is basically an attachment, right? The interest that you have in the subject matter of insurance, yes, whereby if at all it is lost or it is destroyed, it will affect you, right? So you're looking at the financial attachment which you have in the subject matter of insurance, right? And that attachment has to be recognized at law. What I mean by recognized at law, that you, the owner of the property, the way how you benefited or you got that property, it was done through the right means. Guys, can you mute? Rachel, can you mute? Matthew, can you mute? Everin, can you mute? Because you are bringing echoes. Ron, is it Toboreza, Olivia, Rachel, Matthew, please mute. Toboreza, have you? Olivia, Tabitha, and Rachel, please mute as we progress. Rachel, you've not. Okay, let's proceed. So insurable interest is about the financial attachment that you have, your interest in the project, in the subject matter. If you bought a car at 10 million, right? So 10 million is your insurable interest, the amount of money that you put in this subject matter, right, of insurance is your insurable interest. Or that monetary value that you attach to your project or to your object or to what you've insured is what they call insurable interest, a financial attachment, right? Here they say the insured must stand to lose financial if a loss occurs, and such should be recognized at law. Basically, that's insurable interest. That whatever you have, you should have that attachment. If it is destroyed, how best are you affected? If it's existing, how best are you benefiting? Basically, that's around it, okay? That's insurable interest. I bought my car at 50 million. My insurable interest is 50 million. If you go to the banks, right, they always offer loans to companies. They can give you maybe 50 million, okay? However, you bought the car at 100 million. It means the insurable interest for the bank is 50 million, the amount which they put in that car. Then for you also have a 50 million. Altogether it's 100, but however, now, if I told you to apportion a loss, the bank will have the 50 and you also have a 50. So altogether it's 100 million. That's why you realize that the bank will always seek you to give them a policy document to realize that they are protected just in case there's a loss. Okay, let's progress. So why do we always have this concept of insurable interest? Basically, to prevent what they call gambling. In fact, as I told you that all these principles, they're inclined to insurance to demonstrate that insurance is different from another subject or another trade. Some people, they think that insurance is gambling, but however, insurance is never gambling. So because you've put in 100 million, when you are going to insure, you'll insure it within that cost. So a gambler may decide even to insure his property for 5 million because he realized that, you see, that's what I can lose out. So he can pay it for any money. Then that's to prevent gambling, because, you know, if at all this property is lost, I'm starting to lose my 10 million. So you cannot stake it, okay? Because you know the worth of it, yes? Then to reduce the issue of moral hazard. Moral hazard, these are more of behavior, right? They can try to touch his house, okay? But however, if I know that insurance can million, even if I touch my house, okay? I cannot commit that kind of activity because I know session is exactly to what I have. So you cannot touch your property. Then to measure up the amount of loss. Yes, still this is also another principle, another concept that we always get. You see, because you insured your house at 10 million, you bought it at 10 million. If there's a loss and somebody is asking, how much do you have to pay for this house? You can demonstrate that my house is worth 10 million. You have your car, you've insured it at 50 million. If there's a loss, demonstrate I bought this at 50 million. If you have a fridge, if you have any, so this insurable is say financial attachment. So you will always demonstrate your financial attachment when you are going to pay. When there is a loss. So insurable interest helps us to measure up with the amount of a loss. As I progress, I always pause, but I always still give direction of where answers are always asked. They can ask a simple question as that, why insurable interest? And you tend to not to have the right answer. There are only three as we have them. And even in exam, we expect you to have such points. So when must insurable interest exist? Now, how do we relate this? It's basically here we are answering the question that when all the subject matter of it. Now, your financial attachment, yes, should be there when you're accepting cover. When you bring your car, you should demonstrate that my car, I bought it at 10 million. So I have a financial attachment at 10 million. When the policy is running, that's the currency of the policy. You should still show that you still have possession of that car, interest of the 10 million. Then at the last end, when there's a loss, you should have the same insurable interest. A financial attachment should still be there. So at that point in property, insurable interest exists at inception, okay, when you're beginning the cover. Then the running of the policy, that's the currency during the currency of the policy, and then at the point of a loss. So it means it is perpetual. At any point, if you sell off your property, it means you've lost insurable interest. Okay. If you sell off your property, okay, you had this cover from January, and maybe around March, you sell off that property. It means that your insurable interest has lapsed. So even if you have the insurance policy, you cannot claim on that policy because you've lost insurable interest. So here, insurable interest goes hand in hand, the currency, right? When you're progressing, and even at the point of a loss, if you had sold off this car to, say, Rachel, sold the car to Rachel, and then he has not, the moment you make that sale, you've lost insurable interest, and that policy cannot attach to that car unless if you made a transfer to Rachel. But at that point in time, there is no insurable interest that you have. Neither Rachel can benefit from your policy because even her, she didn't accept the policy, right? So the insurable interest in property should exist when you're accepting the policy, during when the policy is running, and even at the point of a loss, you should demonstrate I'm the owner of this property, okay? Then in life, insurable interest is only when you're accepting the cover. So at the point of starting the policy, you should demonstrate I'm the beneficiary and this is me. So that one is always when you are accepting. Why that way?
Sir, you are muted.
Apologies for that. Back to life policies. Life policies, they are transferable. So bearing in mind that they're transferable, you can only allow insurable interest to be there at the inception of cover. So when you're beginning the policy, it should be you, but you can decide to give your property to either your sister, or you can give your life policy to another person. You can give it to a bank, you can give it to anyone provided you are paying the premium. So that one is transferable. Then when it comes to marine cover, and they always ask sometimes the question, when must insurable interest exist in marine, right? Insurable interest only, it is always qualified. The financial attachment is only called for when there is a loss, okay? I said in property up there that insurable interest should be perpetual all round, incepting of policy, during the currency, then at the point of a loss. But when it comes to marine, here in marine, it should be at the point of a loss. Why do they say so? In marine, a transit can start from Japan, okay? And you buy insurance in Japan as the consignee, okay? However, you can sell these goods maybe in Mombasa before it lands Kampala, okay? Or you can even sell these goods, what they call it, overseas. I mean, at high seas, when the consignment is at the waters. So along with that, is as if the insurable interest can face a challenge for you to have a vast movement of here and there. So along that, they qualify that insurable interest can only be qualified at the point when the loss has occurred. Whoever has the financial attachment should claim on the policy which wasn't even initiated by the owner who brought in the consignment. I can buy my cover from Japan, right? However, I sell the car to Jen in transit. So that policy will attach to Jen because he has bought it from me. And when Jen is buying the cover, is going to pay me some of all the costs. And sometimes even even the cost of insurance is part of what it's always covered. So we'll pay the cost. I mean, Jane will pay, or Rachel will pay for the cost of purchase. She'll pay for the insurance, we'll pay for transport, we'll pay for everything. So along that, if there's a loss, that loss will be covered altogether. I mean, Jane will also benefit from that policy because he's the primary owner of the consignment. So at that point, even if you didn't accept the policy, but however, you are the one who has ownership, you'll be covered by the policy which was initiated by somebody who imported the consignment. And a point to note, please, this question is always a point of question, a point of interest when you're examining due. So the issue of insurable interest in these three categories should well be digested, understood to candidates or students as you. Then we're saying the person has unlimited insurable interest. So for yourself, if you're earning video, you can state any limit that you are interested in. So when you go to any life company, you can decide to say, for me, I need to be insured for so much because you have unlimited insurable interest in yourself. So you know your worth and you can decide, provided you can pay premium for it and you're consistent on what you're saying. Then we're saying husband and wife are considered to be one person. So they have insurable interest for one another. And if at all they can have insurable interest for their parents, it should be a cover for only benefits. I'm progressing. Now, how do we acquire insurable interest? So how do we acquire this interest, the financial attachment? I'll always use interchangeably the word financial attachment because financial attachment is basically what we call insurable interest. So the first one is through acquisition or ownership. You buy a property. So when I buy my house or when you buy your car, you're in position to demonstrate that I'm the owner of this property. So you can have insurable interest because you bought, right? Then that's the first step, through ownership or purchase or acquisition. Okay? So you can attain insurable interest. Then the second bit is a bailee, somebody who has goods as a custodian or is taking charge of property. Here you may not have the financial attachment in that property. But however, when you are defining insurable interests, yes, we say its existence or non-existence will prejudice you, okay? So if you're a bailee or you're a custodian and the property is lost, you stand to be accountable for this property, okay? So at that point in time, since you are becoming accountable, yes, you can have insurable interests. You've seen, guys, you bring your car, you take it to a bonded warehouse. So the bonded warehouse, they are free to insure your car. For reason, if there be a loss, they'll stand to be accountable. So they can insure your car, right? Much as they are not the owner of the car. So it's a bailee or somebody who is a caretaker or a custodian can have insurable interest, because the loss of that property can prejudice or can create some bit of negative anxiety if it is lost. So you can insure his property. Then the agent working on behalf of the principal, yes, we say the agent, if you have goods and you see they're at risk, you can free to insure them because you are doing it on behalf of the principal, but at the same time, if at all they are lost, you may become accountable. That's why you have also ways of acquiring insurable interest in that property. We said husband and wife, it is their constitute to be as one person. So along that, if at all I insure a house which is not belonging to me, to my wife, I have insurable interest. Yes, even the husband can insure the car of the wife because we are constituted to be like one person. So they can have one, and they are called as one person. So either party can insure the property of the other, but even if they didn't spend money on either properties bought. Then part or joint ownership. Yes, when you own the business together, of course, I may have a share, but however, if I told a portion of that business is destroyed, however much I didn't contribute 100%, I stand to lose. So I also have insurable interest as a co-owner or a joint owner or out of partnership. So that's the avenue of acquiring insurable interest. And I repeat, please, these are like more bullets, but the answers which we always expect, not detailed answer. You don't have to really write lots of brief on this. You write as it is given, their ownership, agents acting, husband and wife, and partnership. The way out there stated, bailee and all that. So you don't have to write to create a story out of this if at all these questions are brought before you in an exam. So our exams are always simple, and I'm pretty sure you will always pass as others have always passed. Before I proceed, is Sulaiman around? Sulaiman, are you there? Sulaiman, are you there? Okay, participant, if you have a question, you can unmute and ask. First of all, the first principle. If I progress on the second. I presume silence means we can progress, because I've not seen anyone unmuting. So let's all mute. Simon. Okay, let's progress. Brenda, you have a question?
Yes, sir.
Okay, Brenda, you can ask.
Thank you, sir. Sir, pardon on insurable interest, I haven't got you.
I like this feeling. Now, insurable interest. Hello, Brenda, you on the line?
Yes. Yes, I'm
Insurable
online.
interest. We said your financial attachment. Yes, I'll give an example. Brenda, when you buy a car, okay, let's use this pen. When I have this pen, what's the cost for this pen? Brenda, are you there?
500.
500. So that money, which are the 500 or 1K, is that attachment I have in that pen. Right together. If you buy a car 10 million, okay, the 10 million you put in that car is what they call insurable interest. Are you together? Brenda, are we together?
Yes, sir.
That's why I said the
Yes, sir.
financial relationship, because when you are defining insurable interest, we say the financial relationship that exists between the insured and the subject matter of insurance. The financial relationship. So the financial is the investment you put in, okay? But we go further and we say that financial relationship should exist at law, right? Should exist at law. Why do they attach that last point? Because Brenda, you can get this pen, right? Or say you can have a car of 10 million. A car of how much? Brenda, be there.
10 million.
10 million. But you can get somebody to kill the owner, all right? When you're going to get somebody to kill somebody, you can invest your 2 million. Are you together?
Yes.
Even if you kill this person and you acquire a car of 10 million, you've spent your 2 million to hire somebody. That one, you have the financial attachment, but however, is not recognized at law. Are you all now together? What is insurable interest?
Yes, I've got you. Thank you, sir.
Yeah. That's why we say, how can I attain insurable interest? How can I acquire insurable interest? The first one, I can buy. Okay, that's the ownership, all right? The second one, I'm a custodian. I'm taking charge. There, I have not spent money in this property, but however, if this property is lost, I become accountable. So for you to be protected that you can insure, then you can do insurance to the extent that to which you will be accountable, okay? Yes, I can have a car of 20 million. So I have to insure it for 20 million because if this car, it is lost under my ownership, right? I become accountable for the 20 million, all right? The same way, agent acting on behalf of the principal, you may have goods which are worth billions, right? If they are destroyed, if they are lost, you become accountable, okay? The husband and wife is just, maybe it may not be out of ownership, but can be that if at all you have your husband, today he dies, of course you'll be affected, okay? Or what if your husband has put up a story building and that building is destroyed? You won't have where to sleep. So you are affected equally as well as your husband. Then the partnership and joint ownership, you own this business together. So if there's a loss, you are all going to suffer equally or proportionately based on your contribution. Brenda, are you there?
Yes, I'm there.
I'm assuming you have all understood the concept of insurable interest. And thank you for asking that question. Since there's no, is there any question more? Or I can progress? Silence means you can progress. Since there are no chats, okay?
Thank you, Tadeo.
All right. Is there a chat?
No.
No. Sorry?
No.
Okay. Thank you. Okay, let's progress. Now we are going to a second principle, which is the simplest one. This one is called utmost good faith. Utmost good faith. And this is about trust, right? It's about trust. It's about provision of information, which is reliable, which is, I can say, whatever you are giving, you are filtering, yes? Your heart, you know that whatever you're disclosing, it is trustworthy, okay? Whatever information you are providing, right? Here we are saying, when you are bringing your car for insurance purposes, yes, that's at the beginning at the proposal stage. So you know the worth of your car. So we look at the information provision. It has to be consistent. It has to be trustworthy. I mean, it has to be trusted. At the same time, there's an element of the information that is worth giving. So for us, we are saying, when you're beginning a cover, that's at the proposal stage, during the insurance period, and at the point of the event of a loss, okay? I'll try to digress more on that. So when you bring your car, it's at 10 million. Yes, you tell us your car is at 10 million, I bought it at 10 million. That's point number one, right? Now, during the period of insurance, yes, there are additional disclosure that you can make. So if your car, you brought it for home use or domestic use, we call it social, domestic, and pleasure purposes, as in the use for the car. You brought it for only domestic use, which can include going to the supermarket, dropping kids, and the like, domestic use. And tomorrow you convert this car into a taxi or a Uber or something of a sort. It means you've changed the trade of the car or business. Now you need to give additional disclosure. That's why we say during the period of insurance, should anything changes, yes, it has to be brought to the attention of the insured. So if during the period of insurance, the reason something has changed, which is material, here we are the point which is called material facts, okay? There's something which you've changed, but is not important, right? That may not be disclosed, but anything that can change materially, the risk has to be brought to the attention of the insured. Then further, at the point of a loss, still whatever you're going to disclose, yes, it has to be factual or information which is also trusted. Okay, so what is utmost good faith refers to the honest and truthfulness in the presentation of material facts at the beginning, during the period of insurance, then at the point of a loss. All this information has to come forthwith to the insurance company, correct? I'm progressing. This is more of recapitalizing on the same principle, right? The principle of utmost good faith means a higher degree of honesty. It imposes both parties to the contract of insurance. So here we are saying imposing both parties, okay? Both parties, the insurance company and then the insured, they should all give information which is correct, okay? So it imposes on both parties, the insured and the insurance company. Sometimes we assume that this one is the utmost good faith is only on the side of the insured, but also us who are the insurance players, we should all give the right information about the subject matter or the scope. For the side of the insurance company, we need to disclose, to fully disclose any information that we feel is relevant to the client to know, right? In most cases, for covers like, I say motor, all those property covers, when you are going to sell, at given time, we don't disclose excess, yes? We always don't tend that we say you are covered comprehensively, but there isn't anything to do with contribution. So sometimes you need to give a full disclosure of all information of the cover, right? I've seen it in banks. Sometimes you can go for a loan, but you run exactly additional penalties, which are incurred thereabout. So you need to give that full disclosure that if at all there are penalties, you disclose. If at all there are additional costs, are disclosed. But you can go for a loan facility. I'm sorry to take you to another sector. But when you go for a loan, we don't know that, you know, you've applied for 10 million. At the point of disbursement, they can give you 9.5. Yet for the 500, maybe there are other costs which are incurred. So on the side of the insurance company, you should give all this information that if there's a loss, the client knows exactly how it is going to be compensated and to what extent is this compensation going to be. Okay? Now, factors need not be disclosed. We said utmost good faith is giving all information, but not all information that is always disclosed by the clients. Okay, so we are saying that if you've insured your car at 10 million, the first point, those which lessen the risk. Okay, now I said wherever you're going to make material changes to the risk, you need to disclose to the insurance company. But however, if within the currency of the cover or the period, you make the risk better, okay, you've made your risk better. For instance, if your car had no alarm and tomorrow you added an alarm, protection, yes, and theft. These are gears which are put in the car to make the risk better. So it has lessened the risk. The insurance company cannot penalize you because you didn't disclose that your car, it was fitted with an alarm, right? And theft gadgets, right? You put on fire sprinklers on the building. So something that makes the risk better, even if you've not disclosed, the insurance company cannot penalize you because the risk has become better. However, if this factor is making the risk worse, then the element of disclosure has to come forthwith. Okay. Then I'll combine point 2 and point 3. Information of public knowledge of law, even if it's not disclosed, that one we assume that the insurance company should be aware. Okay. If sometimes I give a simple example. If I'm insured my taxi and the taxi is used for 24 hours, right? When you bring your taxi for insurance purposes, then you only disclose that this taxi, okay, I brought my taxi, right? It will be driven Mukono Katosi on the other road. However, I've not divulged additional information that this taxi, it's used 24 hours. And tomorrow you find the same taxi used at night, okay? We assume that anyone who is working in Uganda knows exactly how taxis are being operated. So you cannot pin this person that you know, he didn't disclose to you information that these taxis are used 24 hours. So it's a public knowledge that we all know. Now, if I told there is a change of law, okay? Like right now, we've seen taxis are being registered, some are given direction, you have to use this route, you use this route. And now, if I told your taxis are being in Chebando, they are driving Chebando, Chisalo stage, all right? And there's a law which is passed, okay? That these taxis which were used for Chebando, Chisalo stage, now are being converted to Kaleri and all that, to another area, and the law is passed. Even if we registered as Chebando, as the insured, and tomorrow the law changes that all Chebando stage are going to another direction. So that law, it's brought to the attention of the public. So even if you are not aware as the insurance company, you cannot, yes, because what we are looking out for here, that this may not litter the client's compensation. Ignorance of the law cannot make somebody say is unaware, so it's out of the law. So the insurance company cannot hold the insured accountable if it's about the law. Then the fourth point, those which an insurer deemed to know. Some facts, we know them as relate to that one of the public, right? If I know that the way how the driver, if you disclose to me I'm a driver, a kind of business, sorry, my business is a taxi driver. You know exactly how the taxi operate, okay? If I tell you I'm a public servant, you assume that you know who is this public servant. So you deem to know some of the qualities of the characteristic of this person, whoever has brought you the business. So if the insurer, yes, is deemed to know certain features, you cannot hold the insurance the insured accountable. Then those which the proposer doesn't know, sometimes you can bring your risk and you don't know exactly whether it has inherent features which can maybe bring the risk to become a bit bad. For instance, I can bring in my car and I don't know whether it has an engine, the oil issues, leakage. Okay, I didn't know exactly about these factors. So if I didn't know about some of the elements, you cannot hold me to become accountable for given elements, right? So those ones which the proposer is the insured. Now, those on which the insurer has been put on inquiry. Sometimes you can go for risk and the insurance company's advice, please do additional risk survey, a risk survey to further evaluate, right, the risk. So if the insurance company is put at risk, is put at task to do additional inquiries about the risk. So now it is upon the insurance company, yes, it's incumbent on the insurance company to realize that they do the risk survey to get additional information. So if at all that risk survey is not done, you cannot hold the client accountable for non-disclosure. These are more of the don'ts by the insurer. Yes, sometimes we make false statements. You're saying should not make false statements during negotiation. I hinted a point on that. Yes, sometimes when you're going to sell insurance, you assume that the cover you're offering is comprehensive, okay, and there is no contribution. So along that, if it's discovered that whatever you're offering is not the right product, you need to disclose. You are not supposed to promise the heaven on the earth. So it should give the limitations, if at all they are there. Okay, should not issue policies that are not authorized under the Insurance Act. We are all guided by Insurance Act through the Insurance Regulatory Authority. So IRA mandates each insurance company, but by ways of licensing, to give at given policies. Okay. Now, if you are a general insurance company, you are not supposed to write a right policy. Okay. So as an insurance company, I cannot come and I sell you covers which are not mandated within my license. So that one, the Act guides us very clearly. So if as insurers, we should not give such covers which are not within our mandate. Then should not issue policy which we call ambiguous. And that one is always guided by that rule, which is called parentum rule or limitation. Here it says this rule gives that whoever made a draft of the policy or the wording, should there be ambiguity or something which is unclear, yes, that person, whoever is the drafter, will stand to lose in case there is something which is brought within this element. I'll give an example. You can draw a policy which may have different sections. And then within the section, one section you say, I'll pay you 10 million, section 1. Then within the 10th section, you'll say, I'll pay you 20 million, okay? This is one contract, but one settlement of 10 million contradicts on the 20 million. However, your interest was to pay 10 million. So you've settled something which is ambiguous or which is contradicting one another, okay? Now, if this is as per this principle of contract preferendum rule or limitation, if it so happens that the client lodges a claim or is compensation at 20 million, though you meant 10 million, okay? Your payment, because you see, it will go against whoever drafted the proposal or the statement. Now here, the compensation will be 20 million because it has to go in favor of somebody who didn't draft this letter or didn't draft this kind of information. So ambiguous policy should not be provided. And if there is any ambiguity, it has to be in favor of the person who didn't draft the policy and should have to be construed or interpreted against whoever drafted here. If the insurance company drafted 10 million, however, they meant, 10 million and 20, but they meant exactly 10. It will go against them and the insurance company would be forced to pay 20 million. Progress. And then the other part, we should not use the ignorance of the claimant to pay adequate or less amount of compensation. So in settlement, you should always give the right compensation as when we are going to compensate. That's the last bit that I have on that slide. So these are the remedies or remedies for breach of utmost good faith. Just in case, and more importantly, these are to the insured. If the insured didn't give the right information, what can we do about him, right? We can avoid the contract from inception. It means now we are going to cancel this insurance product cover from inception, that we shall not pay anything. For instance, you've disclosed to us that, your policy, your car is used for private use. And we discover at a given point that your car is a taxi. Okay? The usage has changed. So we can decide to cancel, right, Let's avoid the contract from inception. So we shall say we are canceling our policy from inception and we shall not pay you out of this. Okay, so we've canceled. Okay. We may cancel, you may avoid the liability. It means that if we're told you've lodged a claim, you can decide to say, please, what you've lodged is not payable. That's the liability from that. Because by the time you lodge, you brought this car, it was for private use. At the point of loss, it's a commercial use. So we can say we are not paying you along that for the claim which is being lodged. Certain instances may require compensation. I remember, I'll give a scenario. What we say, sue for damages. At a given instances, you may realize that you brought us a risk for your benefit. For instance, one time we had this client, he insured his car, 50 million, but we discovered later, as we did some investigation, that this car was already involved in an accident, okay? So when he lodged the claim, we had already that information that this car was already involved in an accident. So we appointed an investigator who got the information. So when he brought this information before us, of course, we had to pay the investigator his fee. Okay? At the same time, we need to see exactly this client cancel the policy. So we had to sue him to realize that we recover the amount of compensation, okay, the amount of money that we paid the investigator. So we then have, okay, insurance sometimes is hard to sue, especially for clients. So what we did a quick win, okay? So we simply canceled the policy. The premium which was paid was about 2 million. So he said, there's a very, the investigation report was for 1.5. We paid the 1.5 and we told him we can't pay him. So along that, we are trying to leverage on that ground that, he lied to us, but we cannot go with him because he was lodging a fraudulent claim which was not attainable. Then at a given area, sometimes we waive. We say, okay, let it be as it is, okay? And we compensate the client. So here, when we realize that, okay, maybe this is on business ground, this is a good client, okay? And we realize maybe made a mistake. And that mistake may not be so material, okay? It can be known out of his will, okay? So if we realize it on commercial ground, we can waive our right. What I mean by waiving is just not to apply any of this one. Avoid the contract, avoid liability, sue for damages. So here we waive our rights that we have and we cover and we pay the claimant and we let the cover continue, okay? For instance, you can have your property, okay? And you really assume that those properties there is protection at night. And you discover the point of a loss. Honestly, the security wasn't there. Okay, but in the proposal, you advise there is security guards. So if there's a loss and you discover that, okay, maybe it didn't have security. Okay, however, the compensation could not attach with that security. So on commercial ground, we can say, much as the disclosure was different from what we've seen on the ground, we can pay you on a free basis, which we call ex gratia payment. So we just make a payment based on our will and we pay you out of negotiation. But this one is now it's as if we are not going by what exactly in the contract of insurance, but we are going by what we feel on business relationship that we can pay you. Any questions so far? I tried to entertain questions for the reason that these principles, they are very important for us, especially the fast cards. So if there are questions, you can raise your question or you can. Mr. Dumba, are you there?
Yes, Tadeo.
Okay. Do you have any question about atmosphere faith before I proceed?
No.
Of course.
Yes, Matthew Mugisha.
So, I would like to ask on this remedy of making an ex gratia payment.
Yes.
Can you decide to give him less than the money which was on the contract?
Okay. Now, when we are making ex gratia, here is, as I said, these are commercial grounds. Okay. In most cases, when you're paying you an ex gratia payment, yes, We can decide even to pay you 20% or a 50% based on how we analyze the situation or the relationship that we have with you. So here we are not benchmarking, or we are not looking at the terms of the contract. We are just looking at how best can we negotiate to say that we hold this client paid, right? At the same time, he gets a benefit which may not have gotten.
Thank you very much.
Okay, Martin.
Hello,
Hello?
this is Patient.
Yes, Patient.
May you help me to clarify on the point of avoid liability for that claim?
Okay. Avoid liability simply means that we shall not pay you for that claim that you've lodged. It can be that you've lodged, say you have used this car for commercial, and tomorrow we discover this car was used for commercial purposes. And maybe out of that, it had a dent, yes, of say 10 million. We say we are not paying you. So that's avoid liability for the claim. So we say we are not liable for this claim because the usage wasn't as what you described in the addendums of the cover. Just avoid liability for the claim.
Point taken. Thank you.
All right. Sanlam.
Yes.
Any question?
Yeah, this is Kovia Sanlam.
Yes, Kovia.
May you clarify more on the waive the above rights and let's cover continue? Thank you.
Okay. When I said waiving the above rights, the three elements are our rights of the insurance company. We can decide to say we are canceling your policy because you lied to us. We can decide to avoid, we are not paying you. That's our right. We can decide to sue you because you lied to us. All those are our rights. But what I say, waiving the above rights means that we are going to say, okay, with all these rights, we're not go by them. We are going to let the cover continue. As in, we've really discovered that the car is not used for commercial use, or for private use, it's used for commercial use, right? So we are saying, okay, if we've discovered, let us continue as it is. Okay, so that's waive the above rights and let the cover continue. Is it okay, Paige?
Thank you.
Okay. Can we move on? Or any other question?
No.
I'm asking other participants. Okay, silence means we are all at the same page, so I can move on the other. Now, principle of proximate cause. I'll try as much as I can. Matthew, can you mute? Matthew, can you mute? Cecilia, can you mute? And Pastor, can you mute as well? Please mute. Okay. I'm going to the principle of proximate cause. And I'll try to be as simple as much as I can to realize that we all understand this principle, because it's always asked and students, they find it very hard to explain it. Now, when you talk about principle of proximate cause, we are looking at a degree of events which are all happening together, okay? They are all happening together, but you need to identify of all these so many events. Can you unmute? Of all these events, which one is really accountable for the occurrence of the additional happenings or the end result? Okay, so looking, there is an active, here it's the active efficient and dominant cause that sets in motion. So what exactly brought in all this happen? And I'll simply ask a simple question to ask for us to draw attention to what I mean. You may have a situation where you have an accident, leads to another, leads to another, and leads to another. But you need to draw attention. What caused this accident? I remember one time there was an accident that occurred around the police station of Pamonja, of Jira Road Police Station. Do you remember that truck? Sorry?
Yes, I remember.
We remember that truck. You realize the truck came from up the side, it went down, we rammed to a first car, another car, another car, another car, right? And I remember we almost experienced a death from that accident. So the question, there is a chain of events which are coming through, and you are trying to draw attention. What exactly is accountable for this loss? Okay. Before I even progress, if within the family you have this stubborn girl, and tomorrow she comes back home when she's pregnant, what's the approximate cause? You have this girl, she comes back home when she's pregnant. What's the approximate cause? I've seen this pastor. Pastor, what's your answer? Pastor, are you there? Hello?
Yes, Pastor, please unmute. Yes.
Yes, come again with the question.
I'm asking, you have this girl, tomorrow she comes back home when she's pregnant. What can be the approximate cause?
The approximate cause, because according to the definition of the approximate cause, says the active, efficient, and dominant cause that sets motion, or that caused the peril. So the approximate cause for that girl could be walking at night or joining bad groups.
Another person? Nancy, I've seen Nancy somewhere. Nancy, are you there? Nancy, are you there? Ochan, you are there? Ochan, are you there? Guys, can you be attentive?
Yes, yes, Ochan. Ochan, please unmute. Yes, Ochan.
Yes, am I audible enough? Yes, I would think what would make this girl very deliberate is one, their groups, and secondly, I would think that she didn't respect her body and she went and slept around. And that's why she got pregnant.
Ochan, I was trying to get you, but I couldn't hear you. Nancy J.
Yes.
You unmute, beautiful. I gave that scenario. This girl came back when she's pregnant. What can be the approximate cause?
I think the approximate cause can be the fact that she didn't use protective gears when she was having sex.
Okay. Who else? Shama, are you there? Shama, are you there? You did well at 1 minute. What can be the proximate cause?
It could be that she was not careful.
Sorry?
The proximate cause could be that there was no careful actions.
Okay. At least I've picked some few examples. Say for one for,
Hello,
yes, hello?
this is Patience Sanlam.
Patient, what's your answer? Patient.
Approximate cause would be the parents who have not stopped the girl from going out.
Yeah, at least I've had some good what? Answers. Now, when we talk about proximate cause, we're not talking about what exactly the last cause of a loss. What is the last cause of a loss? Of course, everyone knows that this person slept with somebody, okay? But that's not the proximate cause, okay? So here we are trying to draw attention that what exactly contributed to her to become pregnant, okay? She mentioned maybe the parent didn't take charge of the kid. It can be that this parent, like Pastor mentioned, she was moving with bad company. So eventually she landed into this man. It can be that this girl, she was very beautiful. So she lured everyone to her side. So that can be that it's causing her for everyone to start looking for her so that, I'm going with her. So something which is out there, but it's driving attention others for eventual happening for her to become pregnant. And I repeat, proximate cause is not the last cause of a loss, okay? It's something that influenced, okay? Sometimes I always speak about catalyst. Is there anyone who knows what is a catalyst? Catalyst. Catalyst.
Yes.
Brenda, what's a catalyst?
It's a substance that speeds up the reaction, a chemical reaction.
Exactly, it speeds up the chemical reaction. So that one can be looked at on the other side as hazard, but then here we are looking at here, it's really speeding up, bringing out all these things into motion. When you look at all these phones which are falling apart, yes, you may wonder, why exactly are these phones falling apart? Okay, what exactly driving them? Okay, so insurance company will always look out for proximate cause for some reasons, because some element which are causing the loss or which are setting into motion may not be insurable. So that's why insurance company always look out that there must be a proximate cause, and that proximate cause is element for us to say that you are covered or not. Okay. So on the second page or the page that where we are saying that wherever insurance company is going to pay loss, they look out what exactly draw the loss. Okay. So we'll always look out what is dominant. Okay, because we said proximate cause, the dominant cause that sets in a chain of events. So what dominated with all these events? Okay, so we try to draw attention to, and we say, is the cause insurable? So we ask a question, okay, is this the cause of a loss, which is a peril, is it insurable? Okay, so that's here we can say, is it insurable like an accident? Now we tick. So if it's an accident, the claim is payable. Okay, it can be that the cause of a loss is accepted. It means that it is within the exclusions. The peril that has brought a loss is not insurable. Okay, the peril that has brought a loss is not insurable, or that sets in motion, right? Whatever draw attention to. Okay, if you have flood, okay, brought in a chain. If you have storm, is this storm insurable? If you have right strike and insure, is the right strike and civil commotion insurable? If they are not insurable, because they drove into motion of all these events, we say we are not covering you. It can be that the cause of a loss, which is a peril, it is uninsurable or uninsured. Okay. For instance, somebody deciding to commit suicide. Okay. If somebody decide to sum himself up, then insurance company cannot come into play. Okay, so insurance company will look out for proximate cause to determine whether the loss is payable or not payable. It can be the eventual cause. It can be uninsured, but what drove attention to this loss is not insurable. Then the loss won't be paid. Sometimes I give that example of people rioting during the, Kayunga? Mabida. Remember that period when people rioted within the city? Just allow me a minute. I not charge my battery, apologies for that. I'm saying, if you remember that period of Mabida, the strike which was within Kampala, now it can be that your car was burnt, right? As you're trying to, as people are rioting. Now the approximate cost, it is riot. So if your cover, it excludes right, strike, and civil commotion. However much your cover or the insurance you took on for, it covers fire. The ultimate cause for you, it can be fire. But what drove attention to is the rioters. So much as the fire is covered, but what sparked off all these issues, right? The cover cannot pick the loss because the proximate cause or what drove attention, it is something which is not covered. So the insurance company won't pay for that. Precisely, that's why we need this element of proximate cause to show that whatever we're covering you for, it is covered by the insurance terms and conditions. Any question on proximate cause? Proximate cause?
Hello?
No. Any questions on proximate cause? Silence means you're okay. Participant, any question on proximate cause? Daphne, are we together? You can't hear Daphne. Okay, let's progress since there are no questions. Okay. Now we're going to another yet important principle, which is called indemnity. Indemnity. Indemnity simply means to put you back to the position you were before the loss, to reinstate you back. You've lost 1 million, we shall pay you 1 million. If you look at those tablets, all tabs, okay, you can call them tablets, a Panado, with different colors. If your car is involved in an accident, a portion of it, let's look at the lower one, which has the golden color, blue, and then gray, okay? If your car is dented, a portion of gold, okay, or silver, gold. If insurance company are going to pay you, shall only look at that portion which is dented, because that's what you've lost. Sometimes you can paint or you can spray a color on that shade, and because of wear and tear, the color for the gold looks newer, or that portion which is like gold looks newer. Let's assume the entire car is white. Now, when you spray that portion and the other area is not sprayed with a new paint, the other one part will be like really new. The other one will look a bit pale. For reason, this is the newer paint, but insurance company will only compensate you for only that area because it's what is lost. Okay, indemnity is to put you back to your prior position before the loss, okay? So when you suffer any loss, we shall only pay you. And we are saying indemnity, that the client should not benefit, yes, from any of the loss which he has incurred. So you cannot profit out of this. It's basically to say that compensation to the client should only go to him for only the area that he has lost, okay? So what happens, just in case you realize that, you know, you want a better compensation. Sometimes it so happens that you've sprayed your car, maybe the damage is only for one door, but however, when you spray one side, the second door will look terrible because it is tired, or it is worn out, or the paint is already pale. So you may say, I want even this door to be sprayed for matching purposes. So what the insurance company will do, they'll give you the compensation. However, on that compensation, they will deduct the amount which is used to spray the second door. Okay? So they put you back to your prior position. For your benefit, you'll have a bit of what we call contribution. The insurance company call it contribution. So you'll have to have additional contribution to realize that you are also pay an insurance company. They only benefit, they only paid you for the amount that you've really lost. So that's indemnity. That's more of a continuation of what we call indemnity. But we shall go through why indemnity. Of course, wherever all these principles are put into place, there's always a reason behind it, right? The first one is to prevent the insured from profiting on a loss. Yes, I said you've lost 1 million, we pay you 1 million. So you cannot be paid more, right? So you realize we all pay you for a reason, 1 million, 1 million. So we are saying to prevent the insured, this person, from profiting from a loss, because 1 million we pay you. Then the issue, another issue, secondly, to reduce the issue of moral hazard. I know I'm going to lose one. I know if they have to pay me, they'll pay me what I've lost. So there's no point of me exaggerating because the compensation will only be for that amount that I've lost. Yes, if this is left open, I can even decide maybe to see that maybe the other side of the car also has dents and they also be compensated. But you know, insurance company only pay you for this portion. So you cannot exaggerate your claim because you realize that it is your car and the amount which you've lost is only that. So you cannot claim for something which is more, because even at the point of compensation, that's what will be paid for. So that's the reason behind the principle of indemnity. So exceptions to the principle of indemnity. And here I'll do a bit of digressing to realize that everybody understands this yet important point. Now, the question maybe we can pose, do insurance companies always pay as per the principle of indemnity? Okay. By and large, we may not pay exactly as per the indemnity period for some of the issues which are highlighted here. So here we are saying that insurance company, sometimes they may not pay you as per what you've agreed. When you review through your notes, they may say factors which limit principle of indemnity, or factors which modify the principle of indemnity. When you talk about principles, factors which limit the principle of indemnity, it means that your compensation, if you're expecting 10 million, your payment may be less. So it limits the principle of indemnity. Then those factors which modify the principle of indemnity, they will help you to get something which is over and above maybe the indemnity principle. You've lost 1 million, right? Or that's what you should have been paid, and they are paying you maybe 12 million. So there's something which is above, okay? What exactly you've lost. I'll try to explain these points when I'm going through those lines, okay? Now the first one, the valued policy. What a valued policy? Valued policy, here you agree, yes, at the point of insurance that when my car or my property is involved in an accident, or there is a total loss, you'll pay me 20 million, okay? That's a valid policy. So you've agreed what has to be compensated. But at the point of a loss, okay, you may discover that this car, it's because of depreciation, wear and tear, it is 18 million. Okay, so you won't go back to the insurance company. I mean, you won't go back to the client to advise him that pay me 18 million because that's what I've lost. Okay, you pay me the 20 million because that we agreed. Okay, so that's a valued policy. You agreed at inception what amount will be paid when you are taking on a cover. So that's the value policy. Okay. Then there's what we call replacement cost insurance. Here in replacement, the cover is subjected, right? That should you have a loss, we shall replace you for a given amount, especially on windscreen. It can be that the point of insurance, the insurance cover that you took on, the windscreen was for only 1 million. But at the point of a loss, the windscreen is 2 million. So if your cover, it was on replacement basis, so we shall pay you as what will be brought by the client when you are going to pay the loss. Now, 3 items, and I'll explain, and I want us to understand them perfectly well. Excess, deductible, franchise. Excess, deductible, and franchise. And I request you all to unmute because I'll be asking you a question. Can we all unmute? Especially if you're in a place which is not noisy. Excess, franchise, and deductible, all these are insurance contribution towards a loss. All these are insurance contribution towards a loss. Okay. When it comes to deductible,
Sorry?
I repeat, excess, deductible, and franchise, these are all insured contribution towards a loss, what the insured has to contribute. But the only difference within them is the way how they are treated and who really advises on what. Now, let me start to work out on what we call deductible. Now, when we talk about deductible, it comes from the interest of the client that he wants to pay a lower amount of. Since there is much of echo and then reflection. Let's unmute. So let's mute. Can we mute? May not bring the purpose because I'm hearing echoes. Now, when it comes to deductible, it comes from the point of the insured, yes, who may have higher valued property, but he wants to pay a less contribution when the loss has occurred. Okay. So what happens? The insurers, if at all the client is saying that, you know, you have to pay a contribution of 1 million, the client may say, for me, my contribution will be 10 million in terms of a loss. Okay? So it looks that you can cater for all losses from 0 up to 10 million. Okay? But these properties may be worth maybe 50 billion. So when you advise the insurance company, I tell them for me, for each and every loss, up to 10 million, will all come to my balance sheet. All I'll pay for such losses. So along that is given a discount. So should there be a loss, 10 million, to be catered by the client. Okay. Shama, I'm going to call you. Just a moment. Hold on. Let me first explain all. Then when it comes to excess, excess comes from the side of the insured. Sorry, the insurance company. Here, it is in a portion. Okay. We always give it in 2 ways. Can be 10% minimum a given amount. Each amount can be maybe 100,000. It means if you suffer loss, yes, and we all have pens. I expect you to have pen and to have a bit of calculator, or you can calculate with your phone. If within our policy, it is expressed as 10% minimum 100,000. So this is the expression which is given as an excess. Excess meaning insurance contribution towards a loss. So if there is an excess, 10% minimum, 100,000. It means if this client suffers a loss of 500,000, let's write 500,000 somewhere. So when you're going to compute his compensation, we work out his contribution around that expression, 10% minimum, 100,000. So we start with 100,000, sorry, 500,000 times 500,000 times with 10%. Please, let's work out those numbers. 500,000 times 10%, you get 50,000. When you get 50,000, you compare that 50,000 with the minimum, which is 100,000. Now, when you compare the two, which of the two is higher? Now, when you review through here, 50,000, 100,000.
100,000.
Higher, okay? Now, if 100,000 is higher, on the compensation, you deduct 100,000, not 50,000. So the compensation will be 500,000, which is the loss suffered, less 100,000, and you pay how much?
100,000.
100,000 at net, okay? After deducting the 100,000. However, scenario 2, if the loss is 5 million, scenario 2, the loss is 5 million. Now, you compare using the same parameter. You start with 10% of 5 million. What do you get? Someone who's calculating. 10% of
500,000.
500,000. Okay? Now, having computed 500,000, you compare your 500 with the minimum amount of 100,000. So 100,000 and 500,000, which one is higher?
500,000.
Sorry? Are we calculating? 500,000 and 100,000, which one is higher?
500,000.
500,000. Okay.
Yes.
Now you use 500,000 instead of lessing. 5 million. 5 million instead of lessing 100,000. This time around you less 500,000. So how much is the client paid at net? Sorry?
4.5.
4.5. So have you seen the way how we compute? I'm hoping we all have some bit of calculator. So here we are looking at the amount because excess will always express in both percentage and minimum amount. Okay? Always in deductible, we always give amount in figure, which the client proposes. Though now there's a bit of changes that some clients, they have this policy and has the deductible. Or some insurance company, they even consider deductible to be like the absolute amount. And when it comes to franchise, in franchise, this treatment is not so much in Uganda, but always it's also an avenue of having the client make a contribution. Now, on franchise, here the client, there are two scenarios. Here the loss, here we are looking at the loss in terms of what is considered as the contribution, okay? And at what point will the insurance company come into play to pay. Now in franchise, if the loss is less, the loss is less than what the stated amount to be paid. I repeat, if the loss is less than what is stated amount for the contribution, yes, the insurance company will pay nothing, will pay nil. If the loss is less than or equal to what is stated to be paid, the insurance company will pay nothing. I'll give an example for us to understand. However, in the second scenario, if the loss is greater than the franchise amount or what the client is supposed to pay, the claim will be paid 100%. I'll give two examples for us to understand. Now, if our policy is subject to a franchise of, say, 100,000. This is the franchise amount. And the client suffers a loss of 90,000. A policy subject to a franchise, can you write down as we're progressing? Subject to a franchise of 100,000, the client suffers a loss of 90,000. Here in the expression 1, the client won't be paid any amount because this amount is less than the franchise amount. The second scenario, if the client suffers, the policy is expressed with a franchise of the same amount, 100,000, but however the client suffers a loss of 100,000. This is 0 to 0. See? Now the client won't be paid anything because this amount is equal to the franchise amount. However, if the client suffers a loss, write this figure, 100,001. His loss is 1,001, which is greater than the franchise. Here, this scenario, the client will be paid 100%. So how much will be paid? Will be paid 100,001. So the entire amount will be paid. Okay, so there won't be any deduction. So that's the treatment I was trying to explain to you. That all these deductible, excess, and franchise, they all think about the insured's contribution towards a loss, but more importantly here, to look at the amount which are supposed to be paid. I'll dive into questions as I'm progressing. Questions?
Yes, Mr. Isugu.
You can mute and ask question, or you can raise your hand.
Yes, I was asking.
Yes, ask please.
To you to explain more about deductibles and excess, because I've understood the franchise, but I've not understood the deductibles and excess.
Okay. Another person? Okay, let me try to explain once again. Excess, right? In franchise is about the higher the amount, an amount which is higher than the franchise, the claim is paid 100%. An amount which is less than that, the client will pay. In excess, here we are looking at percentages and contribution. In deductible, in excess, we are looking at percentages and absolute amount. When it comes to deductible, right, for it, basically the client proposes an amount which is even higher than the deductible, okay? You can be, which is even higher than the excess. You can be having your policy that there is an excess of 100,000 minimum. However, the client says, for me, my contribution will be 5 million. So it comes from the side of the client that all losses from 0 up to 5 million, they're all mine, right? So along that, you won't interfere, but you will always bring in on board the amount, all the claims which will be paid they'll start from 5 million and above, okay? So any loss, if at all you have a loss of 10 million as your loss, then they'll deduct above 5 million. So the payment will be 5 million because you've lost 10 million and you have a deductible which you self-advised of 5 million. So they'll deduct the 5 million and will be paid 5 million. In excess, you need to work out the expression as they are given. Here it is coming from the side of the insurance company, but to give a 10% as a minimum percentage, at the same time, an absolute amount. They're all from the insurance side. So I've worked out some examples. What I'll do, because of time, I'll bring out a worked example, which I'll share next time, which is tomorrow. I'll share with you. Then we draw more understanding as you progress. In fact, I'll send this example to Dumba such that you have it a bit earlier and we draw attention to it, because I've just seen there's some bit of time which has lapsed, where I have only 4 minutes, such that tomorrow we can complete the principles. Let's leave it at that, my brother. We shall indulge more. If not understood, I'll make you understand tomorrow. Okay? Then other limitation are the sums insured. As in the sum insured, we say, if at all the client has said my cover is for only 10 million and it suffers 20 million, because you subject yourself to the limit, we shall only pay you 10 million, we cannot pay you 10 million. Then the policy limit exactly is close to the sum insured. The policy limit, you can have the compensation as you limited yourself for a cover of 2 million. Even if you already use 10 million, we shall pay you as per the policy limit. Now, an average is always a condition which is imposed within the policy, such that if the client underinsured, yes, will be paid proportionately based on what he has declared. Still, this one I'll throw more light because it needs some bit of calculation. Tomorrow I'll come with an example because of lapse of time, so that we can go through it. Then in life, always I am free to insure my life for any indemnity. So that one is not largely affected by the issue of the limit, but you can impose and doesn't go with the principle of indemnity. We have only 3 minutes and 2 minutes. If you can have some bit of questions, we can then start from there tomorrow. Do you have questions? Questions?
Thank you so much, Tadeo, for that wonderful presentation. I can see there is a hand from Matthew Mugisha. Yes, Matthew Mugisha.
May I please explain replacement of cost insurance? Replacement cost insurance.
Okay, replacement cost insurance. Here, basically, you agree that the cost of compensation will be on what is presented. Okay, I can insure we always give replacement costs, especially in windscreen or some parts where you don't have exactly the amount which is certain. Yes. For instance, on windscreen, I can insure my windscreen when I don't know exactly the costs. Okay. At the point of loss, any bill that I bring before you is what you will pay. Okay. So that one I won't go into details of exactly how you insure it, but I'll consider what the market is proposing to me. If at all I insure at 10 million, and the cost of the windscreen at the point of a loss is 20 million. However, within my policy, we agreed is on replacement basis. Now the cost which will be brought to me, it will be higher than what we insured. So that's the replacement basis.
Oh, thank you very much.
Mr. Tadeo, when I look in our chat room,
yes.
There are no questions. Maybe you can check on your side, because some participants have a tendency of sending a private messages.
Hello?
Yes, I can see. Someone from Sanlam, please introduce yourself and then ask your question.
This is Patience.
It's a page. This is
Why is life insurance not a contract of indemnity?
Now, in life insurance, indemnity, when you die, as I'm answering, when anyone dies, they put you back in your position. By and large, they cannot resurrect you. It's only Jesus who can resurrect you. So along that, we assume that within life insurance cover, there's no indemnity. They cannot put you back to your prior position. Or they pay the benefits, right? But they cannot bring back exactly what you've lost. Okay? You've lost your limb. Honestly, the limb is gone. What they can pay you are the benefits, the compensation that you brought into play as the limit of which is you've advised. But however, they cannot bring back your limb. That's why I'm saying life
Okay.
insurance is not contract of indemnity.
Thank you, understood.
Sorry about that. Lyman, there are no questions. Lyman, since there are no questions.
Yes, Olivia Musmenta, do you have a question?
No.
Oh, okay. Pastor?
No.
Pastor, what is your name?
I'm Bernard Etimu.
Pardon?
Bernard Etimu.
You are who?
Bernard Etimu.
Bernard Otim. Ah, okay. Okay. Thank you. Adam, you have a question? I can see your microphone is on.
No.
Okay. Yes, Vanessa?
The only problem I faced.
Yes.
Hello?
Yes, Adam, proceed.
Like the time of explaining the proximate clause, where the principle of proximate clause, the network was on and off. So I didn't really get him clearly, especially the principle of proximate clause completely. Maybe I got to know about its definition and introduction about it, but the end proximate clause, I really didn't get him very clearly because of it. He was breaking. He kept on breaking.
Wow. I'll recap that one tomorrow.
Okay, fine.
Should we pick another question, Mr. Tadeo?
Grateful.
I can see we have a hand from Vanessa Navagala. Yes, Vanessa, please unmute and ask your question.
When it comes to franchise, you were trying to, when you were starting, I had, but along the way, when you are going to the calculations, I didn't understand, because the only part I understood was when you were talking about if a loss is less than the contribution of, maybe I didn't understand. The network was on and off.
Your side, I suppose. But what I'm saying, in franchise, yes, there are two options. A claim which is, when the claim is higher than what is stated as a franchise, the claim will be paid 100%. Okay? The client won't pay an amount of money. And I gave a simple scenario. If a loss, our policy is subject to a franchise of 100,000, the client suffers a loss of 90,000.
Yeah.
It means the client will cater for that loss because it's less than the franchise amount.
Yeah.
If a loss is equal to the franchise amount, the franchise is 100,000 and the suffered loss is also 100,000. Still, the client will suffer that amount. However, if the client suffers a loss of 100,000, what I mean is 100,001. Okay, it is exceeding the franchise by how much? By 1 shilling. Okay, at that point the claim will be paid 100%. So all claims which are exceeding the franchise amount will be paid 100%, and for all claims which are equal or below the franchise amount, the client will be the one to cater for such.
Yeah. Okay.
Yes.
Understood.
Thank you. Mr. Dumba.
Thank you, Mr. Tadeo. Vanessa, I can see your hand is still up.
No.
Hope all is well.
Yeah, I've understood. Thank you. Let me.
Okay, I can see Nasije. Oh, Nasije, please.
My question is, when does a franchise apply? Because as Minister Sogas explained to us, that if it is more than the franchise amount, it is paid 100%. And we know about the excess also. That also, for example, if the excess is also applied, it means the insured will only be paid 1 shilling. So when does a franchise apply?
I can tell you, within Uganda, we don't have that policy for franchise. I mean, contribution in franchise. For some reason, it can be abused. Why we say that, I can decide to bring a quotation and I stand by it. Okay? Like I told you that even if it's 1 shilling, it will make the claim to be paid 100%. Okay? But in some instances where you have this client who has been your client for maybe a low customer, and you trust his moral abilities, yes? You're like, okay, for him, he's looking at a situation that he doesn't want to suffer anything, okay? Like you've had scenario where sometimes we have policy where you have a buyback cover, you have the payback for annexes. All those are trying to say that the insurance company will pay as much as you can, provided I've suffered a loss. In Uganda, we don't apply them, but they're always in policy, still policy of what? Indemnity, property policies. What I mean, can be a motor cover, can be a life, can be a house or fire policy or something. But by and large, in Uganda, we don't entertain covers for franchise.
Okay. All right, then.
Okay. Thank you, members. I think it is already time, Mr. Tadeo. I don't know if you're giving us extra more minutes.
No, Mr. Duma.
Yes, Tadeo.
I'll be in for the same class,
okay.
Same topic.
Okay.
So I'll be in position to touch some areas. Because of time, I think we can wind up and then we meet tomorrow. I finalize and I'll have a recap of some few areas that needed clarity.
Okay.
Right.
All right. Thank you, Mr. Tadeo, for that wonderful presentation. And thank you, our dear participants, for staying online. Okay, there is a question, I think, Mr. Tadeo, you are going to pack it. Came from Anna Sanyu. Please explain average and policy limit. I think let's pack this question. Answer it tomorrow.
I had mentioned that average, I need to have some people working for us to appreciate it, understand it.
Okay.
If it comes tomorrow, policy limit along with the policy limit.
Okay. All right. Thank you, Sanyu. Anna Sanyu, captured your question. I think it will be explained well tomorrow. So our dear participants, it's exactly 8 minutes past 10. You can go for a break. We shall be here at 11 for general insurance. Those who are doing general insurance, kindly keep time. At exactly 11, our facilitator will be online. Thank you so much. Enjoy your break.
Okay.